Hey there, everyone. Today on the final bar, another distribution day for stocks with the S&P 500 pushing below that key 4,300 level. The VIX pushes back above 20, meaning fear is running rampant out there. Finally, we'll do a segment called Banking on Breadth. What would we need to see to turn more bullish in this environment? Ladies and gentlemen, this is the final bar. Hey there, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com. Not from Redmond, Washington, here from New Orleans, Louisiana. We're here in town for FinCon, which is a conference for financial bloggers and YouTubers and others. We're learning a lot of really cool things. Hope to introduce some new stuff onto the final bar and elsewhere as we can. But good to get out a little bit. Appreciate your flexibility as we have a completely different format here on the road, but good to be talking markets with you as always. Earnings through the course of the week this week, and overall, not a lot of upside catalysts. There are the Netflixes out there having a nice push to the upside, nice gap higher on a nice report, but there are a lot more Teslas than Netflix, a lot of financial stocks gapping down, others in a lot of different industries represented this week for earnings struggling. Of course, we have that specter of additional geopolitical issues with situation in the Middle East, certainly not seeming to lighten up, but getting more and more serious with certainly far-reaching ramifications in a lot of different places, but certainly for risk assets. We're going to look at all the charts and see how things played out today. The S&P, the NASDAQ, pushing lower, small caps leading the way to the downside. Let's get right to our market recap and look at how things evolved and pay attention to the signals of the day. Before we get there, I do want to answer a poll question that we asked you recently. And I love this one, will the S&P 500 make a new all-time high before year-end 2023? Simple question, yes or no. 2/3 of you said no. More likely we will not reach a new all-time high before year-end. Only 1/3 of you, the optimists in the room, despite all of this evidence pointing potentially lower. My optimists are out there. So what you have to remember is to get to a new all-time high, we have to bring in a little more data here, but you're basically going back about 4,800 or so, right? And that would mean quite a rally, of course. That would be about a 500-point move above current levels, a little bit more as we continue to deteriorate. It's about a 15% rally from current levels. Is that possible? Absolutely. And what's so interesting is we are entering into that part of the year seasonally where that's much more likely to happen, right? October actually tends to be sort of the end of this weaker period. July into August and September in particular tend to be pretty rough for equities. October is where a lot of major lows have come in. November and December actually tend to be quite strong for stocks. Now, there are years where that doesn't happen. And as a reminder here, as we're looking at seasonality, you just have to go back to like 2018, similar in some cases to where we're at now. But if you look at what happened in 2018, we actually peaked a little bit later. We peaked in September. Here, of course, we have a high in July, but September peak led to weakness for the next 3 months. We actually bottomed out in mid-December. So there is that precedent for weakness in the fourth quarter. But if you look at all the other years on the screen, November, December actually tend to be pretty strong in 2017, 19, 20, 21, and elsewhere. We've had a strong fourth quarter. 2022 actually rallied in October, November, had a pretty decent pullback into that higher low in December, as you know, from recent history. So seasonality would suggest strength into year end. The likelihood of us getting above that, late 2021 high, I would list as pretty low at this moment, just given the fact that we've deteriorated so much in the last couple of months. We'd really have to have some stellar November, December returns to get back to that level. I would vote no, but the point of this poll is not to be right, although that's fun. It's more to think through what those scenarios might look like for you and for your portfolio. So appreciate you answering that question. Don't forget to follow us on the social media outlets and subscribe to our YouTube channel. You won't miss the next poll that we send out there. Let's get to the markets and how they've played out today. Again, distribution day really through the course of the day, choppy through lunchtime, but then afternoon Eastern time, rolling over and finishing more toward the lows of the day. The S&P closing around 4278. That's down about 0.9% from yesterday's close. The NASDAQ composite down 1%. And you can see down here, mid caps and small caps down even further. The S&P 600 small cap index, the worst of this group, down 1.6%. But the most important level, I would say, on this page, besides the fact that the S&P went down again, is the VIX with the big 2 at the front of that value. So the VIX 20 level is something we've talked about a lot. If you've noted with some of my recent guests, I've asked them about volatility, if that's something that they focus on, and just sort of talk through what would you need to see, what sort of levels make sense to you. Pretty much most, if not all of them, have mentioned the VIX, and 20 is a pretty important level just to keep your eye on. VIX above 20 means a more uncertain, more fearful market environment, because the increased volatility implies that investors are getting nervous and they're taking a lot of action because of that increased anxiety. We're there, and I think the VIX pushed well above 20, getting up to just above 21. Let's look at some other asset classes here very quickly. Long bond yields finishing the day at 5.1%. That is correct, above the 5% level. 10-year yields just slightly below, same with the 5-year point. So these, which have been down below 5% for quite some time, 10-year yield just getting above there. That's a pretty big number. There's an article I read earlier just saying, bonds are a buy at 5% on the 10-year. That was a Wall Street strategist that mentioned that. I mean, I get the argument. Buying things because it's gone down a lot is never my favorite argument. So the TLT, the AG, the LQD, sort of those main bond ETFs that we track, all in pretty good downtrends and not stopping yet. The TLT, as I mentioned, down about 2% today. Dollar index about 1/3% lower. So not great, not horrible. A lot of green on the page of commodities, particularly in the precious metals. Gold and silver actually pushed higher. And it's worth noting on a day like this, when equity-wise, pretty much everything's down, which areas of the market actually saw gains today. You'll see crude oil prices higher. You see gold and silver prices higher, even some of the soft commodities like corn higher. So you are seeing some improvement in the commodity space. Cryptocurrencies mixed, to be honest with you, but overall really appreciating through the course of the day. Not a huge update. Bitcoin up about 1.5%. Ether prices of about 1/3%, but Bitcoin getting really close to 29,000, which is not too far from 30 and 31,000, which has been the ceiling for Bitcoin a number of times that we've tested that range here in 2023. So getting above that level, I would argue, really reopens that prospect of a more bullish trend for Bitcoin. Let's look at the 11 S&P sectors, really everything in the red, and a couple things were narrowly positive, but by the end of the day, it was all about distribution. The best performing sectors were still down. Communication services and energy, just slightly down from yesterday, 0.1%, 0.2% for each of those, followed by technology, down 0.6%. But look at the sectors that really got hurt today. Consumer discretionary down 2.5%. Big part of that is Tesla down, I want to say about 10%. That might be too much. We'll look in a second here. I don't have the number in front of me. We'll get to it. But Tesla obviously coming down quite a bit as Netflix gapped higher, Tesla gapped lower. Earnings were after the close yesterday, so 2.5% lower. REITs down to 2.5% as well, followed by financials down about 1.3%. Let's look at the daily chart of the S&P. We showed it earlier during our poll, but just look a little bit more at what happened here. So what's happened this week is, I would say last week, as we're sort of wrapping the week, sort of looking back at what happened. The signs for sort of reluctant optimism would be the way I would describe the vibe a week ago, right? Conditions in the Middle East starting to get more concerning, but not end of the world. And in terms of the market reaction to what was going on here, and the S&P, while still below a declining 50-day moving average, not ideal. Wasn't really going down a lot, but it also wasn't gaining. And that's what it felt like. The market felt like a bounce that had stalled out for about 6 sessions. We had almost the exact same trading range. That's this little range here in mid-October. This week now has been about distribution, and particularly Wednesday and Thursday, kind of major down days, closing more toward the lows of the day, lower lows each day. And these last 2 days have gotten us, I think, firmly below this trend line support, firmly back below the neckline. And that's an important one, that 43.50 level. Getting back above there about a week and a half ago, 2 weeks ago, pretty key, because that potentially invalidated this breakdown that we saw in September. I think we've now reinitiated that downside objective. My conversation last week with Chris Verone of Strategas, we talked about different levels. 4,200 is a common level. That's something I'm focused on. The 200-day moving average, the swing low in October, the first Fibonacci support level, all kind of in that purple shaded area, right around 4,200. I think that's still an important one, which is getting closer as we sell off through the course of this week. 40-50 may be the better long-term objective, and that is basically a measurement of the height of this head and shoulders pattern. It gives you a measurement just above that 40-50 level. That would be a 50% retracement of the October low to the July high. So maybe that's where we end up. But again, every time I bring up the daily chart of the S&P, besides looking at the levels and the trends and the moving averages, again, we're still in the middle of these two moving averages, is the momentum, right? The momentum clearly in a weaker phase, right? In bearish phases, when the market rallies and when the price rallies, the RSI usually stalls out at or below 60. And that's what we saw in late August. That's what we saw here now in mid-October. And I think until that changes, then it's easy to assume that the overall trend in stocks, at least on this tactical time frame, weaker rather than stronger. And I think we're seeing that sort of play out here. I want to show a chart of the VIX just to talk a little bit about that change. So one of the conversations that we've had when we've looked at this chart is this 20 level. And I'll update this level, this blue shaded area here, because I just usually have this range right around 20 as a reminder of that's where things start to get interesting. Now, it's not perfect, right? There are times when we spike above 20 during a bull market phase, and it's not horrible, right? It's not a climactic negative sign, but it does end up leading to a pullback and certainly a tradable low in a bull phase. But in a bearish phase, these pushes above 20 often tell you that conditions are really changing. Just look at the VIX and the range that you saw in 2021 versus 2022 versus now 2023 for most of this year, right? You've seen overall over the last year and a half a pretty steady decline in volatility, certainly since October of last year. So for the last 12 months there, lower trend in VIX with that March spike as a bit of an outlier, but we've remained below 20 for most of the year, certainly after April through the present day. Now, all of a sudden, we see the volatility increasing. And what that means, again, the reason why this is usually in line with a distribution phase in the market is people don't get nervous and panicky and start buying in a very slow and steady process. They get nervous, and so the volatility spikes because we panic. Think of it as like this is your blood pressure, your pulse, right? And as you get nervous, your pulse starts to increase, and that's what's happening. The pulse of the market is speeding up, and what that suggests is more negativity, certainly more defensive implications based on higher volatility, usually being more in line with bearish markets than bullish markets. Let's go back to the chart of the 10-year yield, and yields, of course, going higher. This is one of those times. There are times when it feels like there's not a lot to talk about. 2021, fun year to invest because the markets kind of went up, but it's not crazy exciting because things were just kind of progressing in a very low volatility, very consistent way. This is the opposite, and I find preparing for this show every day, it's more crossing things off that I don't have time for, and I usually have about double the amount that we can get to just because of how many compelling charts there are out there. One of the narratives I think that will tell the story of 2023 in future years looking back is rising rates and people's expectation that rates just can't get much higher. And look at how they've continued to progress further and further to the upside. 5% now, pretty close to where we ended the day today on the 10-year yield. That's a level that seemed completely unreachable not too long ago. It is now very reachable. So rising rates coinciding with the sell-off in bonds. So both stocks and bonds highly correlated at the moment, both in the distribution phase, both in a clear pattern of lower highs and lower lows over the last couple months. Rates are continuing to push to the upside. Now, what's so interesting, if you had told me ahead of time, rates are going to be going up, the 10-year is going to go from 3.3% to almost 2% higher, right around 5%, which does better, value stocks or growth stocks? I would say value stocks, no brainer. That's obvious because rising rates just are not as good for growth stocks. Now, that's not what's playing out in 2023. It's still growth over value. And this ratio is still in a clear downtrend. This is the ratio we're looking at here, the Russell 1000 value versus growth ETF. So the line going down means growth outperforming value or value underperforming growth. I think one of the reasons for that is the defensive places you can be in the market right now. If I'm an equity investor and I have to own individual stocks and I want to hide out and sort of ride things out, it's hard to come up with a better place to hide out than some of the mega cap growth names like Alphabet and Apple and Meta and these types of names that have been pretty consistent leadership. And I think that's part of what's happening here. It's certainly not all that's happening, but I think we're bucking the trend of higher rates being bad for growth because the defense of the time here in 2023 happen to be in the growth sectors. It's the biggest names which are tending to be in those areas. In previous cycles, some of the biggest names have been in other sectors like industrials or energy, or decades ago, things like materials, steel companies, right, were sort of the defense of the day, these big blue chip industrial names. Now it's sort of the big blue chip growth names, service names, technology names. And so I think that's what's maybe skewing this ratio a little more than me and others probably would expect. I do want to point out the chart of gold. We don't have a lot of time to go through this as we wrap up the market recap, but the GLD really pushing to the upside. Gold price is really appreciating. We've talked about gold and its role in the markets, what it tends to do. Gold is usually thought of as a safe haven for good reason. If you look back through previous market cycles, gold has been a pretty good place to be, diversifying away from equities, particularly when equities are struggling. Higher inflation has not really particularly helped, and higher rates. The environment has meant gold has not been particularly good, and the strong dollar at times has been one of the hindrances as well. But if you look in the month of October, hard to find a better spot to be than the GLD. The GLD was around 169 at the end of September. We're now up to 183, which is a nice, decent bounce higher. If you draw a trend line from this recent highs, that trend line has now been broken. We've gone from breaking down through the 200-day and making a new swing low, finding support, by the way, at the February lows, and now back above the 200-day. So the momentum is improving. I think gold is an area of that now re-emerging with certainly further upside if conditions continue to deteriorate for stocks. Gold apparently could be a place to be. We'll talk about Tesla here for a moment. As a reminder, we didn't have a live show yesterday. We did a really good show looking at the Magnificent 7 plus 1, what I call the Magnificent 8 stocks. And one of them we included was Tesla, just to look at the overall trends. And, since we were talking about that show, we talked about this symmetrical triangle, this coil pattern, right? Tesla is one of those names that not really going higher or going lower, but really going sideways for the last 3 or 4 months, right? July, really June through October. This is a market in equilibrium, rotating right around $250, $260 a share. This week, really going into the earnings report yesterday, it closed below that lower boundary of the triangle. Today, gapping even lower. Of course, not great news from Tesla. Expectations really being brought down as we look forward for that stock. We're now testing the August low, which is where there's potential support. We're testing the 200-day moving average. So we're right at maybe a point where this would stall out. But overall, I would say the main configuration or the main signal that I'm looking at is a stock in equilibrium that is now broken to the downside. And that usually means there's further downside to come on a chart like Tesla. There are a lot of other names to talk about. Netflix, of course, gapping higher, Microsoft and others, a lot of banks. We're going to move on to our next segment. I would encourage you, as always, to use our scan engine on stock charts. It's a really good way of identifying names that are working and not working, regardless of the broader market environment. Use the scans and alerts to your advantage. We're going to get to our next segment here in a moment, banking on breadth. Before we do that, just wanted to remind you guys, the chat is always open. The show is run live as much as we can, and the chat is there. Please put your questions in there. At times, we'll be able to get to them during the show, but if not, we will put them in our mailbag. It's a great way to get your questions to us. We'll prioritize the ones in that chat as always. We'll do a mailbag segment on tomorrow's show on Friday, so get some questions in now. Maybe we can answer them on the show tomorrow. You can always drop a comment below our YouTube videos with any questions that you have. We'd love to hear from you there. And of course, email us fine as well. thefinalbar@stockcharts.com. A good way to get your questions to us as well. As a reminder, this Monday show, by the way, we'll be doing our next live Q&A. So if you tune in on Monday, tune in right at 4 p.m. Eastern. We'll do a brief market recap, then go right to the chat and answer as many questions as we can live on the show. Let's get to our next segment called Banking on Breadth. Wanted to talk a little bit about the breadth conditions because Deterioration in breadth tends to be one of those kind of main things we look at as just a measure of overall market strength. Now, there are different ways that you can kind of measure market strength or weakness, or what I would say, a lot of people will talk about looking under the hood of the markets. If you missed my conversation this week with John Kosar, that was on Tuesday's show, he has a macro model called the Asbury 6 model, really well done, combines some technical and non-technical inputs into 6 different factors. And the question is, what's the weight, right? Overall, or more bullish or bearish? And that is part of his model of determining overall market direction. And there's a breadth component in there for sure, also price momentum and fund flows and other things. So ways that we can look underneath the hood, breadth is one of the best ways to do that. And breadth basically looks at a group of stocks and tries to measure what conditions that they're in. Now, one of the great ways you can look at breadth is by looking at equal weighted indexes. There's a big problem with the S&P 500 and the NASDAQ 100 and any other cap weighted indexes. What I mean by that is they're weighted by market cap, which means those largest names like Apple or Microsoft or Meta have a huge impact on the weights of on the performance of those indexes. And as I was preparing for yesterday's show, the top 8 stocks, sort of the Magnificent Seven plus one, I guess, Magnificent Seven and Friends, as I call them, those top 8 stocks, including Alphabet's 2 listings, it's about 25 to 30% of the S&P. I think it's around 27 or 28% right now. So almost a third of the S&P are just those FANG stocks, or those Magnificent Seven stocks. That is a huge weight. And you think about how many names starting at the smallest stocks in the S&P, how many names you'd get to have that same impact. It's probably 350, 400 individual stocks that have the same weight as those 8 stocks. So it's a huge discrepancy from the largest to smallest. So one of the things we can do is just look at equal weighted indexes and consider all 500 stocks equally and just look at their performance. So here we're looking at the RSP, which is an S&P 500 equal weight ETF, and then the QQQE, which is an equal weighted NASDAQ 100 ETF. Both of them clearly breaking down in a pattern of lower highs and lower lows, both of them breaking below trendline support in the month of September and then continuing lower. So just at a start, I like charts. One of the technical analysts I used to follow often before he retired, John Mendelson, he used to say, the time I was meeting with him 15 years ago, he was pretty old, grayer than I was, and would all take off his big thick glasses and say, I like trends that I don't need my glasses to see. And I feel like if John were here and looking at this chart, he would agree, clear rotation from uptrend to downtrend, right? You don't need your glasses to see that one. Let's look at some other measures of market breadth. Classic way is just looking at the advanced decline lines, and that's something that I like to do regularly. This is the cumulative advanced decline line for the New York Stock Exchange for the S&P large cap, mid cap, small cap indexes. Are these trending higher or lower? And I think if you just answer that basic question, you get a sense of why the breadth conditions are more negative than positive. Where are they at relative to their 50-day moving average? And is the 50-day sloping higher or lower? So obviously all 4 of these in a bit of a downtrend. These are not updated all for today's close just yet. You can see some of the values are coming in, but most of these basically rotating, trending lower since the end of July. All 4 of them below a downward sloping moving average, a 50-day moving average. So in this sort of environment, I keep it pretty simple, right? As long as these conditions are the same, the trend is down, and that is the overarching direction in the market on this tactical time frame. When we break back above those moving averages, when we start to put it in higher lows, all the things we would do in our normal analysis of price, I think that still holds true with the advanced decline data. So for now, clearly negative. Keep an eye on this chart to see if and when they turn positive. Obviously not yet. Now, when you talk about advanced decline lines, you can also, use the McClellan's adaptation of that. And the McClellan Oscillator is basically turning that daily advanced decline data into an oscillator. And very simply, if it's above 0, it's bullish. If it's below 0, it's bearish. It's sort of a weird configuration right now, which is why I haven't updated the colors as often. I'm sort of reading this as a breakdown. This isn't updated for today's close just yet, but most likely, given the advanced decline data, this is going to push way down into the red area, and I will start shading this this data red once the final print comes in, probably here very shortly. So overall, what this tells you with the McClellan Oscillator going back below zero is that this little bounce that we had in mid-October, certainly the second week of October, with the McClellan Oscillator pushing above zero, just going below zero for one day, but then right back up, that appears to be done. And we now appear to be back into a negative trend, according to McClellan Oscillator. You just need to look left on the chart at these red shaded areas, and you can see two things. Number one, most of the time things go down when they're red. And again, all that's telling you is, when is the McClellan Oscillator below zero? What does the S&P do? And that's the bottom panel. The second observation is that it usually is not, way into the trend. It's usually right as or after the short-term peak is in, the indicator tends to turn negative, because what this is basically doing is looking at the rate of change of the advanced decline data. So it's sort of looking at a derivative of it. Tends to signal a little earlier than some other breadth indicators that I've used. Now, sometimes, like here in April and May, it was more of a time correction than anything. Really didn't lose a lot of value, but it certainly was not a big period of gain. So when the McClellan Oscillator is below zero, now I think it is confirmed going into Friday's session. That just tells me to be expecting more downside than upside for the major averages, and just be prepared for further, potentially further downside beyond that. Next indicator I want to show you is looking at moving average conditions. So this is the S&P 500 in the top panel. The second panel down is the percent of S&P stocks above their 200-day. The third panel down, the percent of stocks above their 50-day. Now, what happened in sort of early mid-October, we saw the bounce off of the early October low. Things seem to be getting a little bit better. And I started to pick up on a lot of optimism on the socials and elsewhere. Some, peers of mine, thinking maybe this is the beginning, maybe that was the bottom in early October. We kind of go from there. And it's pretty common. And we, as technical analysts, if you cover seasonality at all, you're pretty much trained to expect a bottom in October. So anytime you see a big low, it's like, all right, that's probably the one. And then you kind of go, because you've done it enough. But, honestly, I would say that these breadth indicators still suggest caution. What I would need to see is the percent above their 200-day has been below 50% since mid-September, and it had remained above there for quite some time. Now that it's back below, that's more consistent with a bearish phase than a bullish phase. I would look to see when this can get back above 50%. And that would probably mean there's a bit of a recovery happening. That probably means we're putting in a higher low, because a lot of individual stocks will have to regain their 200-day. It's worth noting that while the S&P is still above its 200-day moving average, around 4230, only 1 in 3 S&P stocks are just like the S&P, right? Most stocks are actually already below their 200-day. So this is one of those where this, as a breadth indicator, tells you a lot, particularly in mid-September when this is breaking below 50%. The S&P is way above its own 200-day moving average, but most stocks are actually starting to be below there. So it told you that there was weakness that was not reflected as much on the value of the S&P, but was reflected in the individual stocks that have been breaking down. Looking at stocks versus their 50-day, that flipped below the 50% level back here in mid-August and has remained below there for quite some time. So the way that this works is this would, theoretically, I don't know if it could do anything different. So I'm guessing this would signal first. It may be possible, but I can't process that much math at the moment. So most likely this would break above 50% first. So as long as this green line, the percent above their 50-day moving average, as long as this remains below 50%, things are just not getting much better. If and when, and it's more when this gets above 50%, that's what I would be looking for. This is a really good opportunity, by the way, if you don't want to be looking at this chart all the time. Number one, watch the final bar, because we will be monitoring this, I promise, but also set an alert. Set a price alert on a breadth indicator like this. Here's the ticker. And just tell the alert engine you want to be alerted when this breaks back above 50. You'll get a text, you'll get an email, it'll pop up on the top of your website. You will not miss it. And so great opportunity with some of these indicators that have tickers like this, good opportunity to use the alert engine and just let the platform tell you when the conditions have been reached. The final thing I'll just tell you is with new highs and new lows. I think one of the things that marks a bearish phase is you have way more new lows than new highs. And these are 52-week highs and lows. So what you have to remember is for the S&P to get a new 52-week high, it would have to be above 4,600. So for a lot of stocks, that's a big ask to get all the way up there. But there all are stocks out there like a Murphy's USA and others that we've talked about with these breakout patterns. So they're happening. It's just not very many. And there are way more stocks making new 52-week lows than 52-week highs in most sectors, but certainly in the markets as a whole. The way that we can see this here, and this is the line that I would show you, this first panel below basically tells you at the end of every day on the New York Stock Exchange how many stocks closed higher on the day, or made a new 52-week high minus the new 52-week lows. And so all of this red basically tells you on every one of these days, which was almost every day except for 2 in the last 6 or 7 weeks, there have been more new lows than new highs. And that tells you about a market in distribution. Compare that to what you saw in June and July, what you saw in January and February, more of a period of appreciation, where you saw more new highs than new lows. So this indicator being so far below the zero level, you need to start seeing this get above zero. You need to see some black on this chart, which would mean net more highs than more lows on these given days. That happens, and that would tell you that basically the new lows are not happening as much, and you're starting to see those early leadership names actually start to break out. So that is how I would think of the breadth conditions right now. And again, if you look at the evidence in the charts that I've told you, overall, by far more bearish than bullish on any of these charts that I've shown you. But I think what's great about it in this kind of environment is every one of those charts has a clear signal or a level or a pattern that I think would tell you the distribution phase is most likely done. And based on that indicator, it's a good time to be a little more optimistic. I will be watching those charts. And again, don't forget to use the alert engine just to let the platform tell you when some of those conditions have finally been triggered. Folks, that's a wrap for this show. We've got to go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I was looking at the S&P, slicing it a couple different ways today on a break earlier during the conference today. And one of the things I was thinking about was just looking up momentum. And one of the charts that I like to create for a stock or an ETF or an index like the S&P is looking at the RSI, just the price and the RSI, and then just looking at the ranges in the RSI values and just highlighting in green when they've tended to become overbought on rallies, and the RSI has rarely gotten below 40, which is more consistent with a bullish phase. In red, I've highlighted the periods where we've stalled out at 60 or just above there on rallies, and then we often get down to the oversold levels or break below 40 on sell-offs. And that's, of course, more in line with the bearish phases. Look at what happens in 2021. We're in this nice consistent uptrend, and how the RSI remains in a bullish range. You saw the same thing really from December of last year, really through August of this year. But then something started to change. And when I bring up individual stocks and I talk about how the RSI range, the momentum is getting more bearish, this is what I'm thinking. This is basically the chart that I have in my mind, just thinking of how the whole range in the momentum has gone down, because in a bullish phase, the whole range tends to be pushed higher. In a bearish phase, the whole range tends to get lower. Again, so what this tells me is that the market in a clear distribution phase, lower highs, lower lows, weaker momentum, look for that to change. Look for a higher low, look for a higher high, look for the momentum to improve and get back to that green shaded kind of range, which means we have to get above 60 on rallies. We're not certainly seeing that today. Chart number 2, Lam Research. When I think about some of the earnings this week and some of the names that I think are important, there are a lot of companies reporting earnings here, this week and in the next couple weeks as we process this final earnings season of 2023. Most concerning chart I looked at today relative to earnings, besides Tesla, is Lam Research, LRCX, down about almost 6.5% today, making a new swing low here, or at least testing support around 600, still above the 200-day, but overall putting in some lower highs and now breaking down. When I think of semiconductors, these are sort of the backbone of the modern economy, right? Semiconductor stocks doing well make me feel better about the prospects for economic conditions as a whole, because these are so important for so many products and services that we use. Now we're seeing lower lows, lower highs below the 50-day moving average. The RSI, as we mentioned with the previous chart, in a bearish phase, not getting above 60 on these rallies. And that's a change from what earlier in 2023 looked like. So I think you're seeing a real rotation in semiconductor stocks. LRCX was one of the ones that got hit today or this week with earnings. I don't think that's a great sign, not just for LRCX, but for the broader market conditions. Finally, keep it simple. I mentioned John Mendelson, the legendary technical analyst, mentioning to us in a meeting years ago, I like trends that you don't need to see your glasses or don't need your glasses to see. When I look at the chart of the GLD, I think it's one of those moves as well. Gold really in May, June, July, August, and into September and early October in a clear downtrend. I've drawn a parallel channel connecting these highs and then making a parallel line to track the lows. And look at how this is just a nice, consistent downtrend channel. Those sorts of channels are in place until they're not, until that pattern is broken. And you can see here, a couple of weeks ago, you actually see the rally in gold, then getting above that upper trend line channel. This tells me, or what it should tell you, using the best practices of technical analysis, this was a trend. That trend is now changed. This is a change of character. We need to think of this as more of an accumulation phase. Start to think about the upside potential in gold and talk about a potential retest of the high from May. Folks, that's a wrap for this show. Thank you so much for joining us every weekday after the close for the final bar. By the way, we have a sister channel just called Stock Charts. If you're watching this on YouTube, which you probably are, click on the channels tab above the video or on our main page. You'll see the other channel called Stock Charts. If you're looking for a particular video, look for Panic of 1907. One of our producers did a really cool documentary digging into a previous financial crisis, which if you don't understand, you probably should, because there are a lot of echoes for 1907 and more recent financial crises. If you go there, that's our other channel. It's a lot of great documentaries. Also, some behind the scenes look at stock charts and product updates, which you probably should be aware of as well. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.